Hello, this is Chuck Trice, and this is Common Sense Investing, Commercial Real Estate, and I usually call this show Investment Tuesday. And today we're going to talk about investing with properties and how you can increase your yield. You know, a lot of people use the cap rate, and they use it freely, and they use it all the time, but very few times do we talk about yield. And yield is actually more important than the cap rate. So today we're going to discuss that, just like why do you care? So, you know, when most people talk about cap rate, they just throw out a cap rate like 4%, 6%, 9%. And I get brokers and appraisers calling me and say, what do you think that cap rate ought to be? Well, I mean, that is a loaded question because the cap rate can be about anything you want it to be. And whether that's right or not, there's a way to tell, and that's where we're going to talk about yield. And yield is a rate, and it could be a cap rate in the first year of the sale or any year thereafter if you just take 1 year or look at 1 year. And that's all the cap rate does. The cap rate looks at the year that you're in, and when you look at that year, then you can develop a cap rate. And how do you develop a cap rate? Well, a cap rate is an appraisal process, and it's a rule of thumb. And so if you take a rule of thumb, I mean, that's really not very accurate, and that's what it's meant to be. It's to give you a guide to being able to see. But if you do an appraisal is three parts. Appraisers use the cost approach to value, less depreciation, and they use the direct sales comparison approach where they will compare similar properties with similar units, with similar rents, with similar location and similar quality, and all the things that are similar. And if they're not similar, they'll make plus and minus adjustments to try to make the properties be similar. And so a lot of brokers, they just say, well, let's just take the net operating income and multiply it by times a rate, and that'll give us a value. And they say, oh, or the seller says, I want $400,000 for my project. And so then you divide the income by the $400,000 and you come up with a rate. You say, oh, okay, that's a 6% rate or a 7% rate or 10. That's highly inaccurate. And so it's very hard to get past that because once the price is set, brokers and owners have a hard time getting off that price. But I tell you one thing for sure, when you set a price, in about 2 weeks, the market is going to tell you whether that price is good or not. And so the market never lies, and it comes in with the price, and the price will be what your peers and the buyers and sellers around you think that property is worth. So let's get back to the cap rate. And the way you establish a cap rate is by comparison, and you look at properties that are similar location, similar quality, 20 units versus 20 units, 10 units versus 15 units, and then you can make plus and minus adjustments. Age is a huge difference. What if you got a 10-unit complex that's got 20-year-old water heaters? What if the carpet hadn't been changed in 10 years? And so really, it's very important that you measure this investment with similar properties, and you need to know what that is. Now, you can get a very general idea about a cap rate by looking at, you know, four unit, 10-unit projects or storage units or office buildings or any kind of buildings like that, or even houses, rent houses. And you can pretty well determine within a few points what the cap rate will do. But the thing about a cap rate is when you miss the cap rate by a point or 2 points, that's a dramatic swing. So how do you establish the net operating income? And the net operating income is absolutely the basis of where you start with a cap rate. and the cap rate would then generate the value that you think it should be. The seller or the buyer may have a different idea. But there's several things about the APOD, the Annual Property Operating Data Sheet, and developing the net operating income. We call that NOI, and it has to be true. Now, that's an amazing statement. The net operating income actually has to be true. That's kind of an unheard concept at some times. And know that I'm outside by my train, and I don't actually have a train, but let's move inside to where it's a little bit warmer. And let's see what I've got here that I can put up as my background. I could put that one up there. That's a house that we've got for sale. That house is out on 10 acres. And see what you think about that. So that's a nice little house that we built, and it's for sale for $239,000. That's on 10 acres of land here in Montrose, Colorado. And that wasn't quite the house that I wanted, but I was trying to find it. And you can tell that I am using a green screen. And the green screen works very well. Well, I could put us in the marketing room. I'll just do that. This is the marketing room at NCE where we have our meetings when we have a trade exchange meeting. And I'll be going to Vegas, and we'll be trying to trade properties here in about 10 days. So I may share my screen. Understanding cap rate versus the internal rate of return. Now, the internal rate of return, that will be the yield. And so the yield is what you want. I've had a lot of sellers tell me that, I want 10% on my money. And that's the way most sellers talk and most buyers talk. I want 10%, because you can only make about 1% at a bank or less. And so 4%, 6%, 10%. And a broker misunderstands that question and says, oh, you want a 10% cap rate. Well, that's not correct, because a cap rate is an appraisal process, and it has to do with income, which has to do with net operating income. And if your net operating income is not true, then your whole analysis is shot. It's not true. It'll never be true. And therefore, you cannot develop a good yield. And so the only way that you can develop as a yield is that you do the internal rate of return. Now, I used to do this by hand, and it would take me days to do it, but now I do it with a computer and computer software. And I can establish a yield and a cap rate in just a few minutes, because I take the net operating income, and it has to be true. In other words, that means that your expenses has to be true. That means that your effective income must be true. You got your gross income less your vacancy factor, and then you've got your effective income. Unless your effective income, you take your expenses away. And never add interest to your expenses, and never add amortization. And don't put your kids' cell phones bills in there, and don't put your car insurance in there, because that will distort your net operating income. And so if the net operating income is not true, then your whole analysis is going to be wrong. So let's look here and see what I've got. And here's the appraisal process. And you can see, let's see if I can zoom that up a little bit. And so you go by sales comparison. You can use the gross rent multiplier, and that's just another rule of thumb, very easy to do, and it just gives you an indication. And then you can use the direct capitalization rate, which that is your income, net operating income, divided by your sales price will give you a rate. And you can do cash on cash. A lot of my investors say, well, if I borrow 300,000 and I invest 100,000 of my own money, I want 10% cash on cash. And that's kind of hard to do in most deals, but about the only way you can do that, it'll not equate to a cap rate, because if you did a loan and a cash on cash deal, your investment's going to be more than 100,000. It may be 120,000 by the time you get through with closing costs and appraisals and all of that. So you invest, say, 120,000, and you get 40,000 back on your net operating income. So that's cash on cash. 120,000 I put into the deal, and every year I'm going to get $40,000 back. And so, but that just gives you a measurement on the cash, and it may or may not be true if your net operating income is untrue. But the internal rate of return, which you extend your analysis out 5 or 10 years, then you will get a yield. And that yield is what the investor wants. The investor says, I want 8% on my money, or I want to sell this property for an 8% rate. In other words, I want to make 8% on my money. The bank will pay me so much. T-bills will pay me so much. The stock market will pay me so much. And so I want 10% on my money. And so that would be a yield. And I think brokers need to talk to the sellers and really understand just exactly what the sellers are asking for. So both parties must be speaking the same language. So if you're talking a 1-year yield, which could be a cap rate, or a 1-year net operating income, and you come up with a rate, and that rate is a cap rate, which is an appraisal process, you may or may not be right. But if you extend it out 5 years, 10 years, and your assumptions are correct, then you will establish a pretty reasonable yield. And the way I do that is I know what my income is going to be. I know that on a multi-family deal, I cannot increase the rent, say $50 a year. You just can't do that. People won't stand for it. They'll leave. On a commercial deal, you'll be lucky if you can raise the rent 10% every 5 years in my small market. And so rental increases are a very big thing. So what I usually do is I will vary on a multifamily unit. I might go 2.5% increase every 2 to 3 years. And that'll give me a slight bump in my rental rate, which is going to change my NOI, which is going to affect my yield. Now, commercial property, I might go 10% every 5 years and have that bump in there. And that will affect the yield. And the other thing, the big thing is I will usually increase the expenses by 0.5% or 1% per year, because you know that your taxes could go up. You know that the cost of maintenance is going to go up. You know that utilities are going to go up. You know that insurance is going to go up. So those things are going to go up. And if you have a property manager, well, that's going to go up because you're going to increase the rent. You need to increase the amount that the property manager gets. And most brokers don't do that. So I think the thing is that we need to understand that your analysis is only as good as what your net operating income is to be. And your projections have to be pretty accurate. And how do you do that? You get that by experience and doing a lot of analysis. I do a lot of looking at analysis. And what I see with analysis, in fact, I just got an email the other day. A broker sent me a package, and the package, the APOD, the expense and income statement, had amortization and interest write-offs in there. And you don't do that because the loan is after the net operating income. And so what you want to do is measure how that property is operating. You don't want to do anything else. because the fact that you need a loan, that's kind of a personal problem. We all kind of need a loan once in a while because we can't usually pay cash for a property. So, the loan is after your net operating income. So your net operating income has to be true. And so if I took out that $9,000 in interest deduction and that $2,000 in amortization, which is principal reduction, then I've increased the net operating income by $11,000. And so those things are the things you need to look at. You need to know how to look at an operating income statement. And a lot of brokers just say, well, tell me what your net operating income is, or give me your income. And then they will say, oh, well, here's this potential. I got the potential to do this and the potential to do that. But they don't give you the potential to raise the expenses, which is going to lower the net operating income. And I don't do potential hardly ever unless I'm working on a brand new project or a project that has been so vastly remodeled that you almost got a new property. And so I look at the rental history and I go from there. So now the one thing I wanted to talk about was a seller wants, most of us are going to need a loan when we go to look at a piece of property. So what I'd like to look at is just see how that the loan can increase the yield. And a lot of times people will say, I hate loans. I don't want a loan. I don't want to be tied down. And so, well, we need a loan, and a loan is kind of necessary most of the time. So let me increase this. And this is about what most of us think about a loan. And that loan says, let's introduce the debt. And the debt can be a good tool, but it can also be an anchor. And you see, I've got an anchor on there so that we can see just kind of what that is. And that's what it is. It's an anchor because the lender is saying, yes, I will participate with you. And the lender is expecting a rate of return on his money. In my area, it's probably 6 or 6.5% for a commercial loan. And so the lender says, yes, I will be a 70% partner, or I'll be a 60% partner. You don't hardly understand how that does, but it has to do with using other people's money, OPM. And so let's say you've put in 100,000 and the lender has put in 300,000. And so they're your partner and they're going to expect a 6% yield. And that's what they get, 5.5 or 6%. And that is their yield. Now you want a yield of say 6 or 8 or 10%. And so what will your yield be if you borrow money? And so that's what I wanted to get to today. And I'm going to start with this chart right here. And I use a really good program called the Analyst Pro. And the Analyst Pro allows me to look at these properties and determine what my yield will be, and it will determine when I need to sell this property. So let's get that up a little bigger so people can see it. I thought I could move it over. But that StreamYard logo is kind of in the way. And let's see what happens when I do this. Let's bring that down. Oh, maybe that's a little better. And you can see that this chart on this little house that I was analyzing says that in the year of sale, this will be your yield. And so this is a 10-year analysis. And on the 10-year analysis, you can see that the 10th year, it starts to go down. Could be that I didn't raise rents in the 10th year, but I did raise expenses. But the 9th year is the year that we ought to sell the property. So let's hide that right there in year number 10. So year number 9 is when I'm going to get my highest yield. And so let's go over here and look at my yield and just see what that is. And that yield is 8.24%. So I borrowed money at 5.5%, let's say, and I put $100,000 down, and that yield might be 6% on the property. And that would be an appraisal process. The property is generating a 6% cap rate. But I don't want 6%. I want more than that. So I go borrow money and I can increase the yield. In this case, I will show you how much it increased the yield. And this is a cash flow analysis. And you can see that my unleveraged investment in year 10 is 6.53%. And this is a $150,000 or $165,000 rent house. And I've got my rents in there. My acquisition cap rate is 6.12. My sales price cap rate is 6%. My income increases about 3%. Loan fees and points are 0.5%. But you can see on a 10-year yield, $158,790, the property unleveraged, which means you don't have a loan, is 6.5. Now, the financing cost, the effective rate, is also 5.5. And that, when your rates are that close, it's very hard to make a profit. But my equity yield, my equity investment, which I'm holding it for 9 years, and my equity investment with points and fees is $48,000. And when I sell the place, I'm going to get 8.24%. So you can see that debt increased my yield by 1.7%, nearly 2%. And that's pretty good when on a rent house, because rent houses usually sell with a much lower cap rate, which that means a much higher price. And when you get that higher price in there and that low cap rate, there's just not much room to make a profit. And so the only way you can do that is structuring that loan and borrowing that money in such a way that your effective rate will be, you can benefit, in this case, about 2%. So borrowing money in this case was good. Not all the times to borrow money, but if you wanted to, and the reason is if you had an unleveraged piece of property, which means you don't have a loan on it, then the only increase you're going to get in that cap rate or that net operating income is when you raise expenses. You raise the rents. And when you raise the rents, you're going to get more money, but also your expenses are going to raise. So you're not using other people's money, and so you're not able to leverage that money and make that rate because you're using your own money. If a rent house costs $158,000 and you put $158,000 in there, you're not able to leverage that. But if I can go borrow money at a rate that's lower or very close to the property cap rate, then I can leverage that money and I can increase my yield by 1 or 2%. But you have to be pretty careful in doing that because, as we know, debt can be a very mean thing. And here is the cash flow analysis that I've done. I use two different programs. I use one called Real Data, and I use the Analyst Pro. And you can see right here that my net operating income starts out at $9,672. My operating expenses are $1,500, and they pretty well stay there for a couple of years, and then they start going up. My rent stays the same. I start raising it in year 3 by about $30 or $40. And my annual debt service stays the same. My cash flow before taxes is not much, about $1,500 a year. And so if I sell it in year number 2, I would only make 1.9% on my money, and that's not good. So that would be for those 2 years. But if I sell the property in year 9, which is going to generate the highest yield, then I'm going to make 8.3% for the whole term of 9 years. And so that's pretty good that I could make nearly 8.4% yield on my money that for the past 9 years. And I misspoke on that year 2. If I sold it in year 2, I'd only make 4.8% yield. And that yield is different from that cap rate. You know, the cap rate said this property is worth 6.53%, but my yield is only 4%, and that's because I've got loan fees in there, and I've got expenses that are above what my cash investment is. But if I hold it for 9 years, 8 years is 8.54%, and 9 years is 8.31%. And so I can tell exactly how long I should hold this property. And again, it all goes back to, are my assumptions correct? But it starts in year 1, and it starts with net operating income. And I guarantee you, if your net operating income is wrong, it's wrong. Garbage in and garbage out. Now, there's another thing that we need to look at, and that's your debt coverage ratio. And banks will look at this. The lender's going to look at the debt coverage ratio, and they're not going to want to be in that property for much more than 1.15%, which means you got a 15% cushion. 1.15 is 100% of the debt service plus a 15% cushion. And so debt coverage ratio, net operating income, cap rate, and yield, I mean, those all have different things. And so I can measure the investment, and I make sure that my net operating income is correct, because you're going to use that every year for the whole term of the holding period. So that's what I wanted to bring out and show everybody. To me, it's pretty interesting that you can use money to increase your yield. Debt can increase the yield. I-N-C-R-E-A-S-E. Looked wrong. But debt can also decrease the yield. And that's why I use these programs, is because I can tell in a very few minutes whether I should raise my loan, whether I should ask for a lower rate, whether I should put more money in the deal, whether I should ask the seller to drop the price and give them a reason to drop the price, and ask how did they get the price? Was that cap rate just thrown out there? How did you get that price? Well, you know, a 6% cap rate is not good for me. And I want an 8% cap rate, which means I'm going to lower the price. So this is the way cap rates work. They're kind of backwards thinking. The lower the cap rate, the higher the price. The higher the cap rate, the lower the price you're going to pay for the property. So you always want to get a higher cap rate, because really you're going to make your profit on the going in cap rate. And I see a lot of the investors that I know that they buy a lot of Dollar Generals and big box stores like that. And it's very hard to make a good profit for the investors when you're going in below 9 or 10% cap rate in the year 1. When these buildings the sellers are trying to sell them for 4, 5, or 6% cap rate, that means the price is very high. And so the only other way you can get your yield, which is different than cap rate, is to ask for a higher cap rate, or ask for a rent increase, and hope that you can lower the expenses by good management and good maintenance on the property. And so those things have to be juggled around. You have to be able to increase or decrease a lot of these things to be able to increase your yield. And so to me, this is kind of a fun way to work on these properties and structure these deals and just have fun doing this kind of stuff. So this is the Las Vegas meeting room, and we're going to have a meeting the 21st of this month in Las Vegas. We go there for 4 days. And if you would like to be a part of that, well, just give me a call or send me an email and I can put you in touch with. So we buy, sell, trade, and exchange properties. And we also do a little bit of hard money lending in our area. If you need a hard money loan, I've got several investors that will loan money at hard money rates. And so to me, this is all a lot of fun, and it's just great to analyze these deals and look at them and try to structure the deals. And speaking of trades, I've got several properties that are available where the owners will trade. In fact, today we were just trying to trade a building for 40 acres of land so that the guy that owns the building wants to raise cows. And so if you've got land that you would like to trade for income property, give me a call. If you've got houses that you would like to trade for newer houses or bigger houses, or you would like to finance them and take the monthly payments, and we can figure out a yield on what you would get on your money. Thanks for watching, and this is Chuck Trice, and I'll be signing off. Let's put that down, and we will end the broadcast. Thanks for watching.